Good afternoon, everyone, and thank you for the invitation to come and talk to you again. When I last spoke to you, it was at the Financial Services Expo in Manchester in May, and we were in the immediate aftermath of the MMR, amidst all those headlines, some of them quite lurid, about the tough and intrusive questioning borrowers were having to go through to get a mortgage. And we were hearing lots of concern about the impact on the market, how it was going to stop borrowers from getting mortgages and basically stop the market from growing. It was too early at that point to assess what the real impact of the MMR would be. And of course, it's still very early days yet. We do have Q2 product sales data, which I'm going to be talking about today. And in that data, we're still seeing the post-MMR pipeline cases wash through, and the market is clearly still adjusting and things are still settling down. We're still hearing some moans and groans about some of the practices out there, but I think things are settling down. It's probably going to take 6 months until we've got clear water and we can have a real good view of the impact of the MMR. But I thought it might be interesting for us today just to have a look at what the data that is reported to us quarterly by firms is telling us about what the actual impact of the MMR might be, rather than all the speculation that we read about in the press. And the first point to make is that the market is continuing to grow. And in fact, here you'll see that it's looking pretty positive when compared to lending the past 8-year average. The green line reflects the position as of June, but the Bank of England has reported gross mortgage lending of 19.7 billion in July, the strongest monthly outturn in 6 years, and this has continued in August. With CML estimating gross lending reaching 18.6 billion. Although yesterday we did see the BBA coming out and saying that approvals had been following in August. And you can see from this, from the 8-year average, and in fact actually from last year's data as well, that there tends to be a seasonal dip around August. So we would probably expect things to slow down a bit in the late summer. Lender appetite has clearly shifted towards house buying and away from existing homeowners. And what we've seen post-crisis is a focus back on the house purchase market. And this shows how strong the growth has been in the house buying side. It's sort of bucking the trend, basically, in terms of the rolling 8-year average. It's a very different story for remortgaging. Remortgaging activity remains really very subdued. I'll come back to why that might be later, but I think it's clear to everyone that remortgaging to fund consumption and to consolidate debts has proved to be the unsustainable sector in the mortgage market. And while we would expect to see it come back a bit as interest rates start to rise, it's unlikely ever to come back to the levels that we saw pre-crisis. But what about the impact on consumers? As you know, when we were developing the MMR, we estimated as best as we possibly could at the time what the impact might be. Key to this was to try and assess the impact in terms of how many customers who could have afforded it would be prevented from getting the mortgage finance they wanted, be that either a smaller loan or just not getting finance at all. And you can see from this that we estimated that the impact of the MMR would be pretty marginal in subdued market conditions. Around 2.5% of borrowers in all groups would be impacted by the MMR beyond what had already happened in the market, given that in subdued market conditions, lending criteria tend to be tighter and underwriting standards are more stringent. In the boom period, by contrast, you can see that we felt it was likely to act as a significant constraint by preventing the return to the sort of lax lending standards seen in the 2005 and 2007 period. And from that, you'll see that we estimated that around 11.3% of borrowers would then be impacted. These are the estimates that we published in the cost-benefit analysis that was published alongside the MMR consultation paper in 2011. So breaking that down a bit, these are the estimates about the groups that were most likely to be affected by the new responsible lending package, and those were the self-certified, the self-employed, the credit impaired, and interest-only borrowers. So what has the actual impact of the regime been on those groups? Well, looking at income verification, one of the most significant changes introduced by the Mortgage Market Review is income verification. As of April the 26th, income must be verified in every case. Self-certification isn't acceptable in the post-MMR world, and neither are fast-tracked mortgages. As you can see from this, in 2006 to 2007, at the height of the market, lenders granted £581 billion worth of mortgages, and almost half of that, £269 billion, was granted without any checks being made that the borrower had the income they claimed they had to support the amount being lent to them. And nearly half of all of those self-certified mortgages were sold to employed borrowers, the customer type it was never intended for. In fact, it became so prevalent in the market that it had moved from being a process to being a product. And you could get 44 different products, self-certified products, in 2007. Well, there are no self-certified mortgages today. In the post-crisis world, long before the MMR, self-certification disappeared from the market. But it's a very different story for fast track, which, as you can see, went all the way to the wire. And in fact, you can see from this that just ahead of the MMR coming into force, we saw an increase in the number of mortgages where income wasn't verified. With 20% of mortgage sales in Q2, that's around 52,000 mortgages being sold without income being verified, up from 16% in quarter one. So it looks as though there was a bit of filling of the boots going on immediately before it was all switched off on the 26th of April. In quarter two, there were still 39 lenders in the market. Out of 140 active mortgage lenders, about 28% of lenders reporting mortgage sales where the borrower's income wasn't verified. The majority of sales, over 60%, were sold through intermediaries, and you can see that sharp pickup over the last quarter before it was closed. And here you can see a trend, that we're going to see, as we start to look across all lending in the market. There was a notable shift towards intermediaries from late 2013 onwards, as firms started to get their systems in place and prepare for the MMR. I just wanted to spend a couple of minutes looking in a bit more detail at fast track, because that was really very controversial at the time, and we came up under a lot of pressure from the market to maintain fast track. The problem that we have is that the parameters used to control fast track lending, such as credit scoring, LTV and borrower type, are really very readily relaxed according to the risk appetite of the borrower, of the lender, and their desire to increase market share at any given time. Fast-track mortgages were supposed to be offered to low-risk borrowers, and in fact in the market we did see some lenders apply quite stringent criteria to those mortgages, and for those lenders fast-track mortgages have performed well, with lower rates of arrears and repossessions. But I'm afraid to say that fast-track did not perform equally well among all lenders, particularly for the smaller lenders, where performance was generally worse. And intermediaries soon learned different lenders' internal fast-track thresholds, and it was possible to exploit this to submit business that escaped close scrutiny. The standards that we've seen today, in that 20% that has still been fast-tracked, consistent with the lower risk appetite we've seen across the market, have really improved. So the majority of the recent sales are in the 50 to 75% LTV band, and the trend overall is towards lower LTV bands. But the problem is that while we are now seeing lower risk and more responsible lending practices, as the market picks up, there will inevitably be increasing pressure on firms, as there has been in the past, to consider higher risk lending. And I have no doubt that had it continued, the standards for fast-track mortgages would be relaxed as the market picks up, with a real risk that it would be used as a route for gaming the income verification requirements, particularly given that channeling poorer quality loans through self-certification route is no longer an option for firms. I don't know whether fast-track lenders are likely to come back to us on fast-tracking. I think that we made our decision, and I think the market has accepted it, but it's really very interesting to see that it continued at relatively high levels right to the wire. So it'll be quite interesting to see whether there's any comments made about that. So one of the next groups that we were concerned about the impact of the MMR on was the self-employed. And actually there was a lot of concern across the market about the impact the income verification requirements under the MMR would have on the self-employed customers. In 2007, 70% of self-employed consumers obtained mortgages without having their income verified. As we've just seen, by Q2 this year, that had reduced to 25%, which is still a high number. And we would expect to see that reduced to 0 in Q3, because all income, whether the borrower is employed or self-employed, must be verified after April the 26th. Underwriting self-employed cases and making an informed lending decision based on what evidence there is of the borrower's income, and we have allowed projections of future income where that forms part of a credible business plan. But that underwriting doesn't fit easily with a move towards a highly commoditised approach to mortgage lending, where it's a computer rather than an underwriter that makes the decision about whether to lend. And we were told that as a consequence of the MMR, there would be a number of firms would exit this sector, and they wouldn't service the self-employed because of cost implications, and that the self-employed would be disadvantaged as a result. So what has happened? Well, as you can see from this side, the lending to the self-employed has remained at fairly consistent levels, following a massive drop-off in 2008 when the market contracted post-crisis. We haven't seen the sharp reduction in the volumes of lending to the self-employed. And looking at the type of lender in the market, other than the specialist non-banks, and we would have expected specialist non-banks to exit this market, given that the volume-driven non-banks exited the market just as soon as they arrived, frankly, when their funding disappeared. But other than the specialist non-banks, all lenders have remained active in this market, and we haven't seen the threatened loss of capacity. Retail banks continue to have the lion's share, and in fact it's increasing, and building societies have maintained fairly consistent volumes. And this shows clearly that lending to the self-employed has settled at a fairly consistent level since 2010, and certainly there has been no decrease either in the run-up to or immediately after the MMR. You'll see from this slide, again, that the number of intermediated sales has picked up fairly significantly from 2013 onwards, with an upward tick just ahead of the MMR coming in and fast track being switched off. Turning to the credit impaired, Well, this is the group that we estimated would be impacted the most by the MMR. And frankly, well before the MMR, as you can see, we saw a pretty dramatic correction in the credit-impaired sector. I mean, it's just fallen off a cliff. In 2007, there were 8,000 mortgage products being marketed specifically to impaired credit borrowers. Today, there are very few, maybe 100, not very sure, but not very many. The market share of sales to credit impaired was never very large, of course. At its peak, it was probably around 5%. But there was still material numbers of sales to the credit impaired, over 90,000 in 2006, for example. Over the past year, there have been 2,500. Intermediaries facilitated the majority of credit impaired sales. In 2008, for example, 80% were sold through intermediaries. And it's really interesting to see how distribution has changed. From Q3 2012, for about a year, there were more direct sales reported than intermediated. But then again, from 2013, consistent with the trend we're seeing across the market, the majority of sales are through intermediaries. Credit-impaired borrowers and other borrowers with more complex borrowing needs previously used specialist lenders and products to access the mortgage market, facilitated largely by intermediaries. Those borrowers are now faced with a lack of product and lender choice. Most of the specialist lenders who previously serviced high-risk borrowers have now exited this market, and there are very few products, as we saw, available to borrowers with an impaired credit history today. And the initial interest rates on credit-impaired products are significantly higher than on comparable products for borrowers with a clean credit history. So given limited product availability and high interest rates, most credit-impaired borrowers are likely to find themselves unable to remortgage or to move house. Basically, they are trapped in the mortgage that they have today. Another group that we estimated would be most impacted by the MMR and who also find themselves trapped today are those borrowers who took out an interest-only mortgage with no capital repayment strategy in place. So here we have interest-only. At the height of the market in 2007, a third, that is 32% of all mortgage sales were interest-only, and around 75% of those had no reported repayment vehicle. Sales of interest-only mortgages have declined sharply, and today they account for around 6% of all mortgage sales. So this is another sector that we were told by the bigger retail banks that they would withdraw from servicing the interest-only because the underwriting requirements didn't readily fit with their largely commoditised approach to lending. And again, this was where we were told that consumers were going to lose out. So you can see that actually there's been a fairly steady decline, not just by the big banks, but across all lender types. Interest-only mortgages are a perfectly sensible option for some consumers, but for others they're not. And using interest-only to stretch affordability and hoping that things will turn out okay when it comes to repaying the capital is not sensible borrowing, and it is not responsible lending. Contrary to what I very often hear, the MMR does not prevent lending on an interest-only basis, provided that there is a clearly understood and believable source of capital repayment. And as you can see, consumers are clearly still getting interest-only mortgages. I think possibly the decline in interest-only lending has something to do with the fact that in a buoyant market, lenders could rely on consumers remortgaging elsewhere long before they reached the end of their mortgage term. Whereas in subdued market conditions, such as today's, restricted availability of remortgages and low standard variable rates have given consumers less incentive to remortgage elsewhere. And as a result, we've seen lenders take action to restrict their criteria and be a lot more picky about which interest-only mortgagors they have on their books. It's interesting again to look at distribution, where we see the same clear shift towards intermediated sales from late 2013. So the aim of the MMR is to prevent the return of the irresponsible lending practices we saw in the run-up to the crisis, to try and ensure that we have a much more sustainable market in future and that we don't have to go through this post-crisis fallout again. So the growth that we're going to see in future can no longer come through allowing borrowers to self-certify income. Affordability can no longer be stretched through interest-only mortgages where there's no verifiable source of capital repayment, and credit can no longer be so readily extended to those marginally creditworthy consumers who are going to struggle to repay. Lenders' appetites significantly changed in the aftermath of the crisis when we saw a flight to quality and significantly improved lending standards. And that's not going to be a temporary change ahead of getting back to business as usual. We're not going to see lenders going back to the poor pre-crisis underwriting standards we saw because the MMR isn't going to allow that to happen. That means that many of today's borrowers have restricted choices. Their choices are going to be constrained because there's going to be a mismatch between their risk characteristics, which were perfectly acceptable to the lenders in the past, but they're no longer acceptable to them today. And they have much reduced choice in terms of the products available to them. It was quite interesting to see, I don't know whether you saw Moneyfact's Treasury reports for September, because basically what it said there was that mortgage product numbers, are approaching their pre-crisis levels. But as they pointed out, the growth is fueled by lenders introducing products across an increased number of LTV tiers. Pre-crisis, the market was dominated by products at the higher end of the scale, in particular at the 90% and 95% scales. But the focus has now changed, and what we're seeing in the market today is greater availability of low LTV products, with the mid-range products dominating the market. And basically, lenders are fighting over the quality side of the market. That is not going to help the groups of people that we've been talking about today. Those borrowers are now effectively trapped, unable to refinance or move properties. And those persistently low remortgaging figures may have a lot to do with the fact that those existing borrowers who hold mortgages originated pre-crisis, borrowers with more complex borrowing needs who were previously able to use the specialist lenders and products to access the mortgage market, are now faced with a lack of product and lender choice. Now, we put in place transitional provisions designed to help customers bridge the mismatch there was going to be between what they got in the past and what they were going to get now because of the MMR. So what we were concerned about was the fact that we felt it would be unfair for those customers wanting to borrow the same amount or less to be prevented from doing so because of our introduction of stricter affordability assessments under the MMR. So we have allowed lenders to switch off the new affordability checks to help such borrowers. But it's up to the firms to set their own risk appetite and decide whether they take advantage of this flexibility or not. Ultimately, whether lenders decide to take advantage of these provisions is a matter for them, and we cannot compel them to lend. It's just not possible for us to do that. There are limits on what the regulator can do. As I said at the FSE in Manchester, it is disappointing that some lenders are not approaching the rules in the spirit in which they were intended, and they're not using the transitionals to help out consumers when they could. Every firm has a responsibility to treat their customers fairly, and we expect firms to put good customer outcomes at the heart of everything they do. Leaving customers stuck on higher rate deals when the option exists to move them onto one that costs less is not putting the customer first. And while I'm on the topic of affordability checks, A separate but related issue we are coming across now, we get lots of correspondence on this, is that lenders are applying the affordability rules when there is strictly no requirement under the MMR for them to do so. So, for example, when the borrower is simply switching products or porting the mortgage but not borrowing more. I think firms are going to have to take care not to be too process-led, building processes that go beyond the requirements of the MMR in the interest of cost efficiencies without thinking about the outcomes for the customer. We're seeing advice sales processes which include an affordability check in all cases, whether required under our rules or not. And it's the affordability check that takes the time, and so that's leading to avoidable process delays. And it's also leading to outcomes that are clearly not in the customer's interests. So just to give you a couple, I'm sure you've got lots of examples, but just to give you a couple of examples that have been drawn to our attention. Customers wanting a pound for pound rate switch, which would result in lower payments, being told that they can't afford the cheaper payments. Customers looking to downsize in order to reduce their monthly payment, being told that they can't afford that lower payment. And a customer who wanted to make a lump sum payment, being told that the lender would have to go through an income and expenditure check before they could do that. Perhaps not surprisingly, therefore, as this slide shows, the gulf between applications and approvals continues. I think it's something like declines are running at the rate of something like 60,000 a month. And the primary reason for declines is affordability and the customer failing their credit checks. I would like to point out, though, that you can see the gulf opened in 2009, way before the MMR, and it's actually remained pretty constant, notwithstanding the MMR. So the fact that affordability remains an issue for many, I think, is borne out by the noticeable move that we're starting to see in the market towards lengthened mortgage terms and increased loan-to-income ratios. And this is a closer look at the increase in mortgage terms, which, as you can see, isn't only being driven by first-time buyers, which is what we hear, that is first-time buyers who are driving the longer terms. But you can see that there's been a steady upward trend across the market since around 2010. And of course, we've now seen the FPC sufficiently concerned about this that they've taken action to restrict LTIs. And just on that point, I wanted to take this opportunity to correct some of the comments we've seen about what the FPC have done, somehow reversing the MMR and moving away from an assessment of individual affordability back to the old income multiple approach. That's absolutely not the case. The MMR allows for an LTI threshold to be applied on an individual basis. So just to give a practical example of this, where following an assessment at an individual level, a firm establishes that the borrower can afford a loan that is, say, 6 times the borrower's income. For entirely sound credit risk management practices, the firm may draw a line at 4 times income, and so will use that backstop to limit the actual amount that the customer can borrow. And this was already happening before the FPC did anything. This is a matter of credit risk management. What we started to see in the market was the LTI ratios, the backstop, increasing. That's not to say that individual affordability wasn't being assessed as required under the MMR. It's just that the customer could afford 6 times his income, and firms were increasingly willing to go there and to lend 6 times income. And the FPC action means that that may not continue in future. The FPC move was also for macroprudential purposes, i.e. their aim is to limit the overall exposure of lenders because of market stability risks, and it's not a conduct move. So we're interested in protecting customers from unaffordable lending. And in fact, we did, under the MMR, we did consider imposing LTI ratios. In fact, we considered all sorts of different ratios and whether we should apply those in the market. But we took the view that it's just simply too blunt a tool. So basically, if we drew a hard line, there would always be a credit-worthy customer who fell in the wrong end of that line and was denied access to mortgage finance. And the whole point about the MMR is that everybody who can afford it should be able to get a mortgage. So what else is the data telling us? If we have a flashback to 2007, this is what the retail intermediaries world looked like. And it's changed really very significantly. This is what it looks like today. And you can see that in terms, I don't know whether you can read this, but in terms of mortgage intermediaries, there has been a really very substantial reduction. Overall, since around the end of 2010, there's been a reduction in the number of intermediaries from around 12,900 to 12,250 today. But ARs have increased to 31,254 from 28,651. This data is all taken from our register. We have a register that we call TARDIS, and that keeps details of all firms, and this has come from that. Overall, you can see that there's been a move away from firms specialising in one of the three advice sectors towards a multidisciplinary approach. Not surprisingly, perhaps, the rapid contraction in lending has seen the number of broker firms decline. But as we have noted in the past, your overall market share has shown considerable resistance. So you can see here that since the beginning of this year in particular, volumes have increased. They've actually increased a lot. This shows the trend, and you can see that you're now above 60% in terms of all lending. It's good to see this. It's good to see intermediaries busier than ever. I think there are even questions in the market about whether there is enough capacity to cope with the increased mortgage volumes. Sometimes increased volumes can result in firms cutting corners, and I wouldn't be a regulator if I didn't say, take care, just something to think about. It would be good to see the improved standards across the market since the crisis being maintained and even improved upon. Here we can see the steady reduction in the number of non-advised sales, or as they now are after April, execution-only sales, and the growth in advised sales, particularly over the first half of 2014. Looking more closely at direct sales, they follow the same pattern, with most direct sales being advised. You will, I'm sure, have seen the fine that we imposed on RBS and NatWest in August for serious failings in their advised mortgage sales business. Both firms failed to ensure that their customers were getting the best advice for them. Only 2 out of 164 sales reviewed were considered to meet the standards required overall in the sales process. And as Tracy McDermott, our enforcement director, said at the time, taking out a mortgage is one of the most important financial decisions we can make. Poor advice could cost someone their home, so it's vital that the advice process is fit for purpose. And of course that applies equally to you. You see that intermediary sales, as we would expect, are dominated by advice sales, but it's interesting to see that over the past year there's actually been an increase in the number of non-advised sales by intermediaries. You're probably aware that phase 1 of our MMR thematic review has started. The aim is to understand how the market is working for customers and to assess the quality of mortgage advice being given. So stage 1 is all about advice. We're interested in the extent to which firms are recommending mortgages which are suitable and tailored to customer specific needs and circumstances. And we're also going to be considering the impact of firms' distribution strategies. So this is going to include consumer research, to understand customers' expectations and experiences following MMR implementation, mystery shopping, primarily of mainstream mortgages, to understand how the industry is delivering mortgage advice and assess customer outcomes, an assessment of niche or specialist advice provided to the more vulnerable consumer groups. That's going to be done via file reviews, and visits to firms with different business models to understand how their distribution strategies are evolving in the post-MMR world, and to diagnose the root causes of any concerns identified by mystery shopping or file reviews. The plan is that that discovery piece will report in April 2015, and we aim to share our findings in a way that makes clear our expectations of firms and helps them to embed MMR effectively. What we want to do is encourage firms to move beyond prescriptive compliance with MMR rules and try to deliver best practice and think about the customer outcome. So I've covered a lot this afternoon, and to end, I just wanted to briefly touch on what's coming next. Just the small matter of the implementation of the Mortgage Credit Directive and the move to the longer-term regime for second charge. And of course, we're also going to have to work out the implications of the government's decision on buy-to-let. David Gale is coming tomorrow to talk about these, so I'm not proposing to cover them today. But I'm very happy to take any questions.